Then our next guest gives him a B, if you're going to give him a one-year report card. Michael Morris, Guggenheim's media and entertainment analyst, joins us now. Has a buy rating on the stock, 115 price target. All right, why a B?
Well, thank you, David. I think like any good report card, there are a number of grades. There's some A's out there. I think there's some lower grades. I think there's some incompletes. And when we thought through this process of assigning a grade, we really are just continue to be struck by the vastness of the company, both the challenges and opportunities that Disney has ahead. So this first year has really been about Bob Iger fixing things has been his message, and now putting the company in position to build and grow. And so we do think that he's done a good job. We assign that A value to some of the things he's done structurally to get the company prepared for the future. But those incompletes and those lower grades have to do with things like actually delivering against those objectives. And some of the things around where the company is focused. We like focus on the Disney branded things where we think the company can truly be excellent. And we're less enthusiastic about some of the general entertainment steps that are being taken. And we'd like to see some more progress there.
Yeah. What do you mean when you say, general entertainment obviously is problematic. What are your expectations in terms of steps, so to speak, when you say that?
Well, I don't know the answer to it, right? So the first thing that the company needed to do with respect to general entertainment was to achieve some resolution on Hulu. It's a much bigger situation. You've talked about this a lot over the years, which is this move from the linear television channels ecosystem to an app-based streaming ecosystem. And it is a very, very competitive marketplace right now where companies like Netflix, Warner Brothers, Amazon, Apple continue to invest a lot into trying to win viewers over week after week. When we think about Disney, all the work that they've done for the last 100 years of building brands, making acquisitions of branded assets they've folded into this great Disney property, give them a bit of a head start in competing for those viewers. And so when we look at that Hulu, ABC, Fox Studio side of the business, it is a fine business, but it's not the area where they can really break out from the pack using all that hard work that they've done for the last century.
Michael, how would you assess the hand that Disney holds relative to the competition? Because it seems as if that, the views on this might have changed. Clearly, Netflix is kind of owns the new model in a sense. Those companies more dependent on the linear TV business obviously are more disadvantaged. But in this world where every company's rethinking how much we're going to spend, how much we need to actually spend to service the direct-to-consumer business and all the rest of it, it would seem as if having the franchises and then having the flexibility to figure out exactly how much capital you're going to put behind those things isn't so bad.
No, it's not so bad at all. There's complexity to the question, but I would point out a couple of things. One, I think that it is just a highly competitive marketplace like you just sort of referenced. And you think about Netflix, and we think Netflix is excellent. And they've become excellent by building a massive scaled business and being a leader both in terms of delivering content to consumers and building a brand identity in that way, but also in sourcing content on a global basis. And they're truly unique in that regard in building their scale. But one thing I'd point out about Disney, and there's a lot of concern about Disney and the health of their content cycle, as you guys know, there have been some hit films, there have been some films like the most recent release, The Marvels, that has not performed well. And clearly Bob Iger is focused on getting the company positioned to deliver quality, not quantity in the future. But one thing that I would highlight is the company showed very strong growth in their streaming subscriber numbers last quarter. And a lot of that growth came from outside of the U.S., and a lot of that growth was driven by branded content, Guardians 3, Little Mermaid, Elemental. So these are areas that show some rays of hope or reasons to be optimistic that the Disney-specific model does work. And I think as investors see improvement in the content slate and the power of the Disney brand driving economics, you can see more enthusiasm for the shares and share appreciation.